Everyone saw the headline: COMEX hikes silver margins. And the reaction was immediate. Fear, panic, sell-offs. Social media flooded with the same conclusion. This is bearish for silver. This is price suppression. This kills the rally. But that conclusion is not just wrong, it's dangerously backward. Because what just happened in the silver market is not a sign of weakness. It's a sign of stress. And stress is bullish. Today, I want to walk you through why the recent COMEX margin hikes may end up being one of the most bullish long-term signals silver investors have seen in years. Not because prices won't fall in the short term. They might. But because this move exposes something far more important: the fragility of the paper market in the face of an unyielding physical shortage. To understand this, we need to stop thinking like traders and start thinking like system engineers. Because this is not about charts, it's about structure. Let's start with what a margin hike actually is. A futures contract allows you to control a massive amount of silver with a relatively small amount of capital. That's leverage. For years, traders could control hundreds of thousands of dollars worth of silver with a fraction of that in margin. When the CME raises margins, they're not changing supply, they're not changing demand, they're changing who is allowed to play. Think of it like a casino. The casino doesn't care who wins or loses. But if things start getting unstable, they raise the buy-in. When margins jump to $25,000 per contract, a lot of players are instantly disqualified. Not because they were wrong, but because they were over-leveraged. This is what we call a shakeout. And shakeouts always look bearish at first. Why? Because forced selling hits the tape. Traders who can't meet margin calls are liquidated automatically. Positions are closed, price drops, and most people stop their analysis right there. But here's the part they miss. This pressure does not just apply to longs, it applies to shorts, especially to large shorts. And this is where things get interesting. Bullion banks and large institutions hold massive short positions in silver futures. They've done this for decades. It's part of their hedging, their trading strategies, and in some cases, outright price management. But leverage cuts both ways. When margins rise, shorts must also post more cash, a lot more. For a large bank holding tens of thousands of contracts, a margin hike is not an inconvenience. It's a liquidity event. They must come up with billions in additional capital just to keep their positions open. Immediately, no negotiation. And here's the key question. Where does that capital come from? In a calm market, it's manageable. In a stressed market, it's dangerous. Now let's layer in the most important factor of all, the physical silver market. Because this is where this time is different. In past silver crashes, 1980, 2011, price was driven by speculation, excess leverage, manias, narratives untethered from reality. When margins were raised back then, speculative demand evaporated, and there was plenty of physical metal, so price collapsed. But that is not the environment we're in today. Today, silver is in a structural physical deficit, and it has been for years. Industrial demand for silver, from solar panels, electric vehicles, electronics, and grid infrastructure, has exceeded mine supply by over 200 million ounces annually, year after year. That deficit is not theoretical. It's cumulative. It drains inventories, relentlessly. And that's exactly what we've been seeing. COMEX inventories are down dramatically from their peaks. Registered silver, the metal actually available for delivery, is under constant pressure. This means something crucial. Paper selling does not create physical silver. You can flush out paper traders. You can smash the price on a screen. But you cannot meet industrial demand with futures contracts. This is the core misunderstanding. Margin hikes affect paper players. They do not affect factories. A solar manufacturer doesn't care about COMEX margins. An EV supply chain doesn't care about RSI. They care about one thing. Can they get silver when they need it? And increasingly, the answer is only at higher prices. This is why physical premiums matter more than futures prices. If price drops but premiums stay high, it tells you everything you need to know. Paper is weak, physical is strong. And that's the setup we are moving into. The margin hike is a filter. It removes weak hands. It reduces noise. It strips leverage from the system. What's left behind is reality, and reality looks like this: relentless industrial demand, rigid supply, declining inventories, and massive short exposure sitting on top of it all. This is where the pressure builds. As weak longs are flushed out, selling pressure temporarily overwhelms price. But physical buyers step in. They always do, because their demand is inelastic. At the same time, shorts are now under more stress than ever. Higher margins mean higher carrying costs, higher risk, lower tolerance for adverse moves. At some point, one or more large shorts blink. And when a short covers in a thin market, price doesn't drift higher. It jumps. That jump triggers margin calls on other shorts, which forces more covering, which drives price higher, which creates a feedback loop. This is how squeezes form, not overnight, but structurally. The margin hike doesn't stop the squeeze. It sets the stage for it, because it removes the illusion of stability. It exposes who is undercapitalized. And it reveals how fragile the paper structure really is. Most people see volatility as danger, but volatility is information. It tells you where the stress fractures are. And right now, every stress indicator is pointing at the same thing. Paper silver is stretched thin, physical silver is scarce, and leverage is being forced out. This is not bearish, this is purification. Now, let's talk about how this actually plays out. Because understanding what is happening is only half the equation. Understanding how to read it in real time is where most people fail. After a margin hike, the market almost always does the same thing first. It panics. Price drops sharply, headlines turn negative, sentiment collapses. This is the moment when most participants make the wrong decision. They react to the screen instead of observing the system. Because the futures price is not the market. It's a reflection of leverage, and leverage is what's being purged. So when price drops after a margin hike, the first question is not, is silver dead? The real question is, what is the physical market doing? This is the critical distinction. If physical demand weakens alongside price, then yes, the move was speculative. But if physical demand remains firm or strengthens, then paper selling is being absorbed, silently, aggressively, and absorption is bullish. This is where inventories tell the truth. Watch COMEX registered stocks, not total inventory, registered. The metal actually available for delivery. If price falls but registered inventories keep declining, that is not weakness, that is confirmation. It means physical buyers are using the paper sell-off to secure metal. And once that metal leaves the system, it doesn't come back. This is the trap. Paper traders believe margin hikes and rallies. Physical buyers see margin hikes as discounts. This is why price suppression narratives miss the point. Suppressing price doesn't fix scarcity, it accelerates it. Now let's talk about shorts again, because this is where the asymmetry becomes extreme. A long can lose what they put in. A short has unlimited risk. When margins rise, shorts are forced to reevaluate their exposure, not emotionally, mathematically. How much capital is required to maintain the position? How volatile is the asset? What happens if price spikes instead of falls? In a structurally tight physical market, those questions become dangerous. Because all it takes is one delivery shock, one unexpected demand surge, one inventory report that confirms depletion. And suddenly, covering is no longer optional. This is how paper resistance disappears, not through gradual selling, but through forced capitulation. And when shorts capitulate in a market with inelastic demand, price doesn't retrace politely, it gaps. This is why margin hikes often mark turning points. They flush out noise and expose who is structurally wrong. Now let's address the argument everyone makes at this stage. The market can stay irrational longer than you can stay solvent. That's true. But here's the nuance. The market can stay financially irrational. It cannot stay physically irrational. Factories don't run on sentiment. Solar panels don't care about narratives. EV production lines don't pause for futures positioning. Silver is not a discretionary asset. It's a necessity. And necessities behave differently under stress. When price rises, demand doesn't disappear. Margins compress, costs are passed on, production continues. That's what makes silver uniquely dangerous for shorts and uniquely resilient for holders. Now zoom out. What we are watching is not just a silver event, it's a credibility event. A system built on leverage is colliding with a resource that cannot be printed. For decades, paper markets controlled price discovery because physical supply was abundant. That condition no longer exists. The margin hike is the system acknowledging stress, not solving it. It's like tightening bolts on a pressure vessel. It holds until it doesn't. And when it fails, it doesn't leak slowly, it ruptures. This is why volatility should not be feared here. It should be understood. Volatility is not chaos, it's information. Spikes followed by pullbacks, sharp reversals, sudden moves on no news. These are not signs of exhaustion. They are signs of imbalance. An imbalance always resolves. The only question is how. If physical demand continues to absorb paper selling, if inventories continue to decline, if shorts continue to require increasing capital to maintain positions, then the resolution is not lower prices. It's repricing. Not speculation-driven repricing, but necessity-driven repricing. This is the difference between a trade and a structural transition. Trades end. Transitions reshape markets. And this market is transitioning from leverage to ownership, from paper claims to physical reality, from price management to price discovery. Now, let's be clear about risk, because pretending this is easy would be dishonest. There will be violent pullbacks. There will be engineered sell-offs. There will be moments where confidence is tested. Interventions can distort outcomes. Rules can change. Timelines can stretch. This is not a straight line. It never is. But what matters is direction. And direction is set by fundamentals. As long as silver remains structurally undersupplied, as long as industrial demand remains inelastic, as long as inventories continue to drain, paper volatility is noise. This is why unleveraged exposure matters. why patience matters, why understanding structure matters more than timing. This is not about predicting the next dollar move. It's about recognizing regime change. When systems reach this stage, they don't unwind politely. They unwind under pressure. And when leverage finally breaks, it doesn't ask for permission. If this analysis helped you understand what's happening beneath the surface, like the video, share it, subscribe. Because this situation is evolving in real time, and the difference between panic and preparation is awareness.